It's April 2020. The world is in a lockdown. Flights are grounded, factories are shut. Nobody is driving to work, nobody is flying anywhere, nobody is doing much of anything really. And oil, the one commodity that runs almost everything, has no use. Think about it. Oil cannot sit in a pipeline waiting patiently. It has to go somewhere physical. A tank, a ship, a storage facility. And by April 2020, those tanks were full. Completely full. The world had stopped consuming oil, but it hadn't stopped producing it. Saudi Arabia and Russia were in the middle of a price war, pumping furiously, and there was simply no more space to put stuff. So on April 20th, 2020, something happened that had never happened in the 138-year history of oil trading. The price of oil went negative. Not zero, but negative. Minus $37 a barrel, which means, and I want you to pause on this for a second, sellers were literally paying buyers to take oil off them. Now on the same day, in Essex, a suburb outside London, a group of 9 traders working from their homes made $660 million. All of it in just a few hours. Now here's the question that I haven't been able to stop thinking about since I first read this story. Was that skill or was that luck? Did they see something nobody else could see? Or were they just in the right place at the right time? And more importantly, for you and me, does it even matter which one it was? Luck or skill? Because I think the question about luck versus skill in trading or investing is one that we need to sit with honestly and, if possible, figure out how to separate one from another. I'm your host Sandeep Rao, and this is an episode about luck versus skill in trading and investing. But before we go any further, let me ask you something. What is luck and what is skill? And how do we tell them apart? Because I think most of us generally believe we know the answer. Luck is when something good happens while you don't really expect it to. Skill is when something good happens because you think you put in the effort to make it happen. Simple, right? Except in markets, it's almost never that clean. Think about it this way. 2 traders, same returns, same portfolio. One of them did deep research, understood the business, and sized the position carefully. The other one heard a tip at a dinner party and threw money at it. For 1 year and maybe even 3, you cannot tell them apart by looking at their results alone. Luck and skill in the short run can produce identical looking outcomes. So how do we actually separate one from the other? Morgan Housel, who is a partner at the Collaborative Fund and serves on the board of directors at Markle, has this post titled Lucky versus Repeatable, something that I would encourage you to read. In that post, he talks of a test to separate skill from luck. Skill is anything repeatable. Put the same person in the same situation and they'll get the same result. Luck, on the other hand, is anything unrepeatable. Change one thing about the circumstance, the timing, the market, the counterparty, and the outcome changes completely, regardless of what the person did. That's it. That's the test. In other words, it's nothing to do with did you work hard or did you do your research, but could you do it again in a different environment and context and get the same results? Now here's where it gets more interesting. Michael Mauboussin, in his book The Success Equation, which is probably the most rigorous thing written on this subject, adds a different layer to this understanding. He says luck and skill aren't really 2 separate boxes, instead they are a spectrum. He takes the example of roulette versus chess. So on one end is roulette, pure luck. No amount of skill changes your odds. On the other end is chess. Almost pure skill. The better player wins almost every time. And in the middle of it is markets. And here is what makes markets so uniquely difficult. It sits close enough to the skill end, and skill genuinely exists in this space. There are traders and investors with real demonstrable edges. But it also sits close enough to the luck end that in a given year, you simply cannot tell whether you are winning because of skill or luck. Mauboussin gives us one more test that I find really interesting. He says, if you can lose on purpose, skill is involved. You see, you cannot deliberately lose a roulette. The roulette wheel doesn't care what you intend. But you can deliberately lose a chess. Just make bad moves and you're gone. Markets, you can lose on purpose, but Here's the not so obvious part, it's actually harder than you think, which itself should tell you something is different about markets when it comes to the luck versus skill spectrum. Now for a moment, let's go back to our Essex boys for a second and apply this framework. Were they skilled? Well, they understood oil trading, settlement mechanics, storage dynamics. That knowledge was real. But could they do it again? The conditions that created that particular day, a pandemic, a price war, tanks full to the brim, a contract expiry falling on that specific Monday, those will never converge in exactly the same way again. Hence, the repeatability test fails. So were they lucky? Well, mostly yes, but not entirely. And that grey zone, that weird space between mostly lucky and fairly skilled, is exactly where most market outcomes sit. Which brings us to the next question. If that grey zone is where everything happens, how do we make better decisions inside it? In markets, that is. How do we know if we or someone else succeeded due to skill or luck? So we have a framework now. The repeatability test, the spectrum. The idea that markets live in a grey zone between luck and skill. But here's the biggest problem. In real life, in the middle of a trade or after a great year or when someone shows you their portfolio returns, we don't really apply these frameworks. Instead, we tell stories. And the story we tell is almost always flawed. Daniel Kahneman, whose book Thinking Fast and Slow, something I have recommended many times over, spent years studying this problem. He once analyzed the year-on-year performance of wealth managers at a large financial firm. These were experienced professionals, people who had been doing the job for decades. And what he found was appalling. The correlation between their performance from one year to the next year was essentially zero. Not low, but zero. Statistically, their results were close to a coin toss than anything that could be called a skill. When Kahneman showed them this data, these smart and experienced professionals looked at it, nodded politely, and didn't change a single thing about how they thought about their own abilities. Here's what was happening. They were judging their skill by outcomes. A good year meant skill at work, and a bad year meant bad luck or difficult markets. This is what Kahneman calls the illusion of skill, and it is almost universal in markets. There's another concept that Taleb talks about in the book Fooled by Randomness. He calls it the invisible symmetry. For every Essex boys story we hear, there are dozens of traders who made the exact same bet that day and lost. But you won't find a Bloomberg story about them. You see, we look at winners and build narratives of genius around them. We never see the losers and the identical strategies and identical conviction they had, but maybe they were not lucky. So when we look at the Essex boys and ask, was that skill? We are really only looking at half the picture, the half that survived. And that's what survivorship bias is. So the point is, if we can't trust outcomes or performance, and we can't trust selective success stories for sure, then what is left? What should we trust? This is obviously not an easy problem to solve. Let me sidestep and take you through something specifically in the context of market performance. SPIVA, which stands for S&P Indices versus Active, publishes a report every year that tracks how actively managed funds perform against their benchmark index. The findings are remarkably consistent year after year. Over a 10-year period, roughly 90% of active fund managers in the US underperform a simple index fund. In India, the numbers are somewhat better, but the general direction is the same. The majority of active managers over long enough periods fail to beat the benchmarks. Many of these managers look skilled in bull markets. Their funds go up, their investors are happy. But what is actually happening in most cases is what someone like Kahneman would recognize immediately. They are capturing beta and not generating alpha. Beta simply means their returns move with the market. When markets rise, they rise. When markets fall, they fall. The skill effect, which is alpha, what you generate above and beyond what the market gives you passively, it turns out is very, very rare. This is the illusion of skill at an institutional scale. An entire industry managing trillions of rupees where the majority of participants are being rewarded for being in the right place at the right time and not for the quality of their decisions. To genuinely evaluate whether a fund manager has skill, you need to do two things. First, look at performance across full market cycle, not just a bull run but through a downturn as well. Second, look at consistency of outperformance over a decade or more. Because as Mauboussin points out, in a noisy and grey environment like the markets, you need a very long track record before you can statistically separate skill from luck. And most careers aren't long enough for you to be exactly sure of this. If you're still with me, you would ask, well, we are back to square one. So is there really a way to be sure if it's skill or luck in a given situation? So here's my final take on what we as traders and investors can actually do to deal with this luck versus skill issue, whether it is for ourselves or when we evaluate others. 1. Let's accept luck for what it is. We are affected by luck the moment we are born. We do not choose the country, the family, the decade, or the circumstances we arrive into. That is the original luck, the one none of us earned and none of us could have engineered. But accepting luck doesn't mean becoming fatalistic. There is a concept I really like, the idea of increasing your surface area of luck. The more you learn, the more people we engage with, the more situations we put ourselves in, the more we read and experiment and show up, the more chances luck has to find us. While we cannot really manufacture a black swan to take advantage of it, but we can be the kind of trader or investor who's positioned to benefit when the situation arrives. Let's accept luck for what it is and then do everything in our power to be ready for it. 2. Let's focus on what is actually in our control. In the Bhagavad Gita, there is a line most of us have heard at some point in our lives. It's almost a cliche. Karmanye vadikaraste ma phaleshu kadachana. You have the right to your actions, never to the fruits of those actions. Or, as we all have heard in Hindi, karm kar aur phal ki chinta mat kar. I always thought of this as an advice to myself only when I am in deep drawdowns. But after reading and rereading The Success Equation by Mauboussin, I realized he is saying the same thing, just through the lens of mathematics and probability. The only thing in our control is our process, our research, our position sizing, our decision-making framework. The final outcome, whether the trade works, whether the market cooperates, that is and never was fully ours. Taleb says the same thing. A trader who loses money on a correct probabilistic decision made the right call. The outcome doesn't retroactively change the quality of the decision-making and thinking. Bhagavad Gita, Mauboussin and Taleb all say the same thing. Focus on the process, don't obsess over outcomes in the short run. If we want to genuinely get better at trading or investing, or anything for that matter, we need to look for parts of the process we can repeat frequently and get feedback on quickly. How we research, how we size positions, how we manage risk, these are things we can do dozens of times a year and improve on. The same logic applies when you are evaluating someone else. A surgeon who performs 500 operations a year will reveal their skill or the lack of it relatively quickly. For a macro fund manager making 3 big calls over 3 years, we may need 30 years of data before we can say anything statistically meaningful about their performance. So yes, that is pretty much what we can do with this problem of luck versus skill, in markets and in life. But it's important that we deal with it honestly, because how we think about luck and skill shapes what we expect from our actions, and ultimately how we improve. And that brings me to the end of this episode. I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'd be happy to respond. Till then, take care and trade safe. I'll be back soon with the next one.